When will the market bottom out? We could be getting close. Hi everyone, I'm Mark Lichtenfeld, author of Get Rich with Dividends. Welcome to State of the Market. Don't forget to like and subscribe if you want to see more videos like this one. Every investor, or nearly every investor, and I'll get to that in a moment, is terrified that this bear market is going to get worse, a lot worse. But I don't agree. In fact, I'll tell you how much time I think this bear has left in this video. But first, let's look at the majority of investors who are really concerned right now. A friend of mine who's worth well into the 9 figures told me he believes today's situation is worse than 2008. Now let me stop you right there before you run out and convert all your assets into gold Krugerrands and gasoline. This is not 2008. In 2008, the entire economy was on the verge of collapse. High-ranking government officials had stacks of cash in their go bags in case they needed to leave the country in a hurry.
What's in the satchel?
It's full of money.
This is high inflation, possible recession. That's very different.
They're very different.
Another friend, also very wealthy, he retired at 36, literally said to me, I am freaking out about this market.
I'm freaking out! I am freaking out!
He said he's down 16% this year, and he told me this right after he said he was up 27% the prior year, which means he's still up 7% from 2 years ago. But all he could focus on was the losses.
$20. I wanted a peanut.
Now I'll tell you what I told him. You have to remember, bear markets are typically short-lived, just 9 months on average. But while you're going through them, it can be soul-crushing. It's like being dumped. It can feel like your whole world has ended, and if only Janet would take you back, everything would be okay again. 2 years later, you're in a bull market and a new relationship, and you've forgotten all about Janet and the way she used to stroke your hair and tell you how handsome and strong you are. It's not just my investor buddies either. The usual sentiment indicators, which serve as a vibe check on investor outlook, are all pretty awful right now.
Well, I'm going through a little bit of a rough patch. Whole year, actually.
The American Association of Individual Investors Sentiment Survey found that 53% of investors are bearish, while just 19% are bullish. The historical averages are 31% bearish and 38% bullish. So that is pretty bearish. Now, at the same time, the University of Michigan Consumer Sentiment Index hit its lowest point in decades, which is astonishing when you think about it. I mean, sure, inflation is surging, but unemployment is extremely low, just 3.6%. There's only been a handful of times over the last century that the unemployment rate has been lower, and that was back when hats were mandatory, and we weren't great at measuring this sort of thing.
They want us to do it this
I don't know that way. Why would they change math? Math is math.
okay,
Math
Dad.
is math.
That said, at the risk of sounding a little goth, all this doom and gloom could be a good thing.
I think it is fun thinking about death.
I was more looking forward to this than I am my birthday.
Historically, when sentiment reaches extremes, markets tend to move in the opposite direction shortly after. But there's one guy I know who doesn't seem bothered one way or the other. This is the guy I mentioned earlier. He invests in dividend stocks every month for the long term, and despite everything, he's as calm as a Buddhist monk in a day spa. Now, he says he likes it when the market goes down. He gets to buy his dividends cheaper and with better yields. And while I strongly advocate investing in dividend stocks, it's not me I'm talking about. It's an actual friend of mine. Now, he's in his 40s, so he has some time. But as long as you don't need the money you're investing in right now, who cares where the stock prices are today? You don't need that money for a while, and bumps in the road like these are a part of any long-term investment plan. If you haven't got the time to sit around and wait for markets to recover, you should be using stops to pull your money when things get hairy. And if there's no room for risk in your finances, the funds you need for the short term should not be in the market. They should be somewhere safe like cash or short-term treasuries or CDs. Now, I think when my friend said that today's situation is worse than 2008, he was mostly picking up on the overwhelmingly negative sentiment from investors. People seem more scared now than they were during the financial crisis in 2008, but as I mentioned above, this extremely bearish outlook is often an indicator that we're getting close to the bottom. That doesn't mean we may not slip into a recession or that stocks won't go lower. In fact, I'd expect one more drop before we bottom, just to shake out the last of the sellers.
I'm out.
Once that happens, the storm will likely be over. Now, if I had to guess, I'd say the market bottoms sometime in the next 3 or 4 months. And remember, the economy doesn't even have to get better for that to happen. The market is a forward-looking indicator. Remember, the market bottomed in March 2009 when the economy was still terrible. In fact, it usually works the other way around. A bottoming market points to better times on the horizon. So hang in there. This ugly market won't last forever, and maybe not even that much longer. For more wealth and income building tips to see you through this rough patch, check out my free e-letter, Wealthy Retirement. Just click on the link in the description below. Thanks for watching State of the Market. I'm Mark Lichtenfeld. I'll see you next time.